Today we're deep diving into Hexcel Corporation. They're a really key supplier of advanced composite materials, absolutely vital to the aerospace and defense sector.
And the core issue, the fundamental tension we're looking at, it really revolves around its valuation, doesn't it? Is let's say, the current high premium the market's putting on Hexcel actually justified? Justified by that long-awaited commercial aerospace recovery and the inherent stability of its defense business.
Right. Or is it the other way around? Do these near-term financial struggles, the chronic margin pressure we've seen, and these, frankly, dangerously high operating multiples, do they signal that the stock carries substantial, maybe even catastrophic risk?
Exactly.
My position is that Hexcel is actually an undervalued growth play here. I think it's structurally positioned for, massive margin expansion down the line, and the market is perhaps unfairly fixated on what are ultimately temporary, cyclical headwinds.
See, I come at it from a different angle. While yes, the long-term industry outlook is certainly robust, I believe Hexcel is aggressively overvalued today, right now. The valuation reflects a kind of perfection scenario that honestly just isn't supported by the company's current financial health, its execution track record, or frankly, the significant operational risks tied to things like customer concentration and the lingering instability of the recovery itself.
Okay, so my bullish case really centers entirely on the intrinsic value I believe Hexcel is set to unlock as this volume inflection finally materializes. Look, we acknowledge that valuation models can vary widely for companies in transition. That's fair. But the forward-looking discounted cash flow scenarios, particularly those emphasizing EBITDA growth over the next 5 years, they consistently point toward a fair value, potentially exceeding $96 per share. Now compare that to the current price, around $69. That suggests a potential upside of more than 35%. And this confidence, it isn't just baseless speculation. Hexcel's is actively shedding those short-term headwinds, think OEM destocking, managing inflationary pressures. The structural long-term growth story, you can see it evidenced by analysts projecting a pretty impressive earnings per share growth rate of, 16.40% over the next 5 years. And maybe most importantly, the commitment from management is tangible. It's financially impactful. They've announced a significant new $600 million share repurchase authorization, and that includes a $350 million accelerated program. Management is, quite literally, putting shareholder capital behind their conviction in future cash generation.
Okay, that's an interesting point, but we have to look critically at the enormous price discrepancy Hexcel commands against its present reality. I mean, the market is pricing Hexcel like it's some disruptive hyper-growth software as a service company, right? But it's a cyclical industrial material supplier.
Well, it's a high-tech materials supplier.
Sure, but consider the numbers. Hexcel currently trades at an index PE ratio of 82.10. 82. For comparison, its profitability is extraordinarily weak right now. We're talking a return on equity ROE of just 4.36% and a frankly dismal profit margin of 3.69%. Now, to put that PE in context, its price to earnings to growth ratio, the PEG ratio, it stands at 5.01. I mean, this metric tells us the company is priced for near-perfect, sustained growth for years to come, and that's a standard that's almost impossible for a cyclical manufacturer to meet consistently. And regarding those valuation models you cite, okay, while the most optimistic DCF models might push toward $96, other models, like those based on current dividends, they suggest a value as low as $19.63. Now, that enormous variance, that fivefold difference, to me, that doesn't signal a growth opportunity. It signals profound speculation regarding when or even if the company actually achieves its potential. And we see validation for the skepticism in recent operational history, right? Hexcel missed Q1 and Q3 earnings estimates in 2025, and they've already been forced to revise their full-year guidance downward. That doesn't scream confidence in near-term execution.
Okay, let's delve into those immediate operational challenges then, specifically the stability of margins. Because I agree, that is where a lot of the execution risk truly lies.
Exactly.
Now, I see why you focus on the current operational drag. The gross margin decline is stark, yes, It dropped to 21.9% in Q3 2025, down from 23.3% the year prior. And yes, that trailing 12-month EPS decline of nearly 35%, it's alarming on the surface. However, I'd argue these are not structural profitability failures. They are transition costs. I would frame these inflationary pressures, which, management themselves cited as costing approximately 200 basis points of margin, as aggressively manageable.
Manageable how, though?
Well, management is taking surgical and strategic action. They are systematically streamlining the high-cost base. Look at the divestiture of non-core industrial businesses, and crucially, closing that high-cost Belgian facility. These are strategic changes, not just temporary fixes. They'll provide permanent structural relief to the cost structure once that volume really returns. And the market, correctly in my view, looks forward. The anticipated forward EPS growth, 35.76% next year? That demonstrates a clear consensus shift. It recognizes these margin contractions are temporary effects, destocking, restructuring, not some chronic failure. Furthermore, the balance sheet provides ample resilience to weather this transition period. The debt-to-equity ratio is quite manageable at 0.48, and the current ratio is robustly healthy at 2.75. That confirms Hexcel is not facing a liquidity crisis during this ramp-up phase.
While, yes, balance sheet health is necessary, it doesn't justify paying an 80 times PE multiple for a company with a, 3.69% profit margin currently? The operational drag feels deeper than just temporary inflation to me. That specific margin pressure cited on the long-term A350 contract, that isn't easily negotiated away. And the substantial TTM EPS decline, that reflects, I think, a deeper inability to manage fixed overheads effectively during these low-volume periods.
But the volumes are set to increase substantially.
Yes, but we are paying a premium today for leverage that likely won't fully appear until 2026. Maybe even 2027. The fact that profitability is so compromised right now means the company operates with essentially zero margin for error. Any additional delay in that commercial recovery, or maybe a further slip in execution on these restructuring plans you mentioned, well, that could result in a significant correction, precisely because the stock is priced so far ahead of its current reality.
Okay, that brings us directly to the issue of the commercial aerospace recovery itself. You suggest risk, but I really see structural advantage here. Hexcel's core business is just so deeply embedded in the supply chains of the aerospace giants. The risk of them losing that business is negligible once production normalizes. They aren't just a commodity supplier.
Embedded, yes, but concentrated too.
Absolutely. Hexcel supplies, over 80% of the carbon fiber needed by Airbus? It's crucial to Safran's CFM LEAP fan blades, the ones powering the next generation of narrow-body jets. Airbus alone accounted for 40% of 2024 sales. This is a high-moat, specialty material component provider. They will benefit disproportionately from the inevitable multi-year supercycle. This deep integration, I think, mitigates risk far more than simple customer concentration might suggest. They are, effectively, the bottleneck. Furthermore, Hexcel is actively future-proofing this position. They're investing heavily in next-generation composite structures and materials. Look at their partnership with Arkema on carbon fiber reinforced thermoplastic tapes. That positions them to capture lower production cost markets in the coming decade. They're not standing still.
But you cannot just dismiss the risk tied to that extreme customer concentration. When 40% of your revenue is tied to Airbus, any production delay, any regulatory issue, any quality control problem at that single OEM hits Hexcel with, potentially crippling force.
But Airbus needs Hexcel as much as Hexcel needs Airbus.
Perhaps. But skeptics, myself included sometimes, point to a history of multiple false starts since the pandemic. Periods where Hexcel promised a ramp-up only to have it delayed or fail to fully materialize. We saw this explicitly in Q3 2025, didn't we? That 7.3% decline in commercial sales was, as you noted, due entirely to OEM destocking on core programs like the A350 and the 787. This shows Hexcel is still fundamentally reactive to its customers, not really driving the cycle itself.
It's a partnership, inherently reactive to some degree.
And before we move away from operations, I want to challenge your assertion that they are well prepared for the ramp-up.
Hexcel has relied heavily on attrition to manage headcount during these low volume periods. Now, if the commercial recovery accelerates as rapidly as you predict in 2026, doesn't the company risk significant workforce capacity constraints? I mean, this strategy of attrition might save some short-term costs, sure, but it threatens their ability to actually meet the sudden surge in demand, the very surge that's supposedly justifying this high valuation. That seems like a critical operational risk.
Okay, let's shift focus then to the stabilizing force, the defense segment. I maintain that defense strength provides far more than just stability. It acts as a critical technological and financial hedge. The space and defense segment posted robust growth, up 11.7% in Q3 2025. That's significant.
It's positive growth, yes, but is it enough?
Well, while defense revenues alone may not carry the entire stock valuation, the technological edge it represents is crucial to the market premium, I believe. Hexcel consistently patents lightweight materials and processes advancements in 3D printed carbon fiber parts, composite structures for rocket booster casings, high-temperature composite honeycomb. This innovation is protected, and it feeds directly into secure, often high-margin, government contracts with agencies like NASA and the Department of Defense. This demonstrates a sustained demand for their high-end materials that is structurally independent of those volatile commercial airline cycles.
I agree the defense segment is positive and it's technologically impressive. No argument there. But is it truly sufficient to offset the operational exposure on the commercial side? I don't think so. The defense revenues simply do not scale quickly enough to carry the significant fixed overhead costs associated with those highly specialized large-scale commercial facilities, the ones currently running below capacity due to destocking. It's a stable anchor, absolutely, but it's just too small to meaningfully leverage the company's overall cost base right now. Furthermore, if management has such high internal conviction in that $96 value you cite, why are insiders selling? Insider transactions show net selling activity reported at negative 2.35%. Insider transactions. That includes notable sales by the CFO and an EVP. Now, while these are often framed as routine liquidity events or option exercises, substantial insider selling hardly signals strong internal confidence that the stock is currently undervalued and poised for that 35% upside you predict, does it?
It's one data point among many.
It's a significant one, though, and we also can't just ignore the legacy risks. Hexcel has faced significant legal entanglements in the past, antitrust issues, a settled case involving faulty fiberglass supply for Navy submarines. These complexities, even if they are historical, they point to a highly regulated and potentially litigious operational environment that requires specialized management attention, and it adds another layer of, let's call it background risk to that already high valuation.
Okay, so the debate really confirms that Hexcel is caught in a difficult but ultimately strategic transition. The bearish outlook, while I acknowledge it's analytically rigorous, I think it focuses too heavily on temporary margin compression and historical PE figures. It fundamentally overlooks the power of Hexcel's, frankly, irreplaceable structural position and those strong projected EPS growth rates tied to what seems like an inevitable multi-year commercial aerospace ramp-up, a ramp-up that management is strategically positioned and I'd argue financially resilient enough to capture.
And I'd say we agree that Hexcel possesses a powerful technological base and an essential defense business. However, the premium commanded by the stock today, that 80x PE we talked about it, requires absolutely flawless execution on the commercial recovery. The evidence, as I see it, points instead to repeated delays, a risky level of customer concentration, and ongoing margin decay in the near term. This high valuation leaves almost no room for error should that highly anticipated 2026 inflection point fail to materialize perfectly, or, as I mentioned, if Hexcel's potentially limited workforce capacity prevents it from meeting that pent-up demand when it arrives.